Hi, thanks so much for tuning in. This is BQ Prime, as you know, and we're going to be in conversation very shortly with the Deputy Managing Director of SBI Mutual Fund. And I think it's going to be an insightful conversation, not just because he'll be able to give you perspective on fixed income and everything else with regard to investments, but also he'll be able to tell you how Bharat is behaving. It's really interesting. And I'm going to start, in fact, Mr. DP Singh, thank you so much for taking the time. I'm going to start with a question on that because SBI Mutual Fund, more than any other mutual fund, has very deep reach, goes to several tier 2 and smaller cities and towns in India. A lot has been said of late about the resilience of the Indian investor. But what are the flows telling you from the past couple of years? Has there been a dramatic shift since the onset of the pandemic?
Yeah, there has been definitely a shift. And the shift is the people post-pandemic has understood the value of investing. Actually, why investments or savings are more important. And today, when anybody wants to go to the next level of savings, the first thing is to move to mutual funds.
Right.
Because of so many reasons. One, our capital market is behaving very, very beautifully over the period of time. People have seen the success stories and people want to follow the success stories. And people are putting in money. And luckily for us, the kind of deep coverage we have, the deep reach we have been able to become the agent of change for those people who wanted to be there.
Could you give us some granular data that will give us a sense of this? Say if you talk about 2022 and you talk about the reach that you've had, is this primarily bank driven because of the kind of reach that SBI obviously has, or are people coming to your network by themselves?
No, I'll tell you, I'll give you an example of one of the NFOs which we had last year. That is a Balanced Advantage Fund. Astonishingly for us also, we got money from 94% PIN codes of the country.
Wow.
93.6% PIN codes contributed in that fund. That gave us a lot of satisfaction, solace, and that made us feel confident that yes, we can reach everywhere. And the best thing about these people who are coming from, in our parlance when we call out B30 or the smaller towns, when we talk about them, very, very stable money. They generally don't churn.
SIPs is obviously the most stable form of investing into mutual funds. This is now propagated as the industry has gone out, said SIP sahi hai. But for you specifically, is how much of the flows come through SIPs, one, and what kind of SIPs are you seeing from the smaller towns and cities?
No, that's very valid question. Actually, if you ask me my SIP size, more than 50% of my money is coming from the smaller towns.
Okay.
More than 50%.
Wow.
So that's a big number. And overall, if I talk about our business, we get around 25 to 30% of the retail business coming from the smaller towns.
Okay. I want to ask one more question about the behavior. Now, you pointed out a very interesting statistic about the number of people and the share of your SIP book coming from the smaller towns. In terms of product, do you think that there's more that needs to be done in terms of education of the scope of the product? What are the choices that people are making with regard to the mutual fund scheme that they're going in for SIPs for? What is that telling you?
No, definitely there's a lot needs to be done as of now. Because what happens, we all are aware, mutual funds are B2B, generally right. B2B. Though there's a B2C portion also, which we are doing digitally, or we people are coming directly also, because we have a unique system of direct plans in India. But still, majority of the money is coming through intermediate route. Right. Especially, I'm talking about the retail side of business. There, the extremes are there. On the one side, person is putting money only in savings bank account and FD, and the other side, the lot of money is coming out to the 100% equity funds.
Right.
There's a need of educating that it has to be a step-by-step approach. It has to be through conservative hybrids, to balanced advantage funds, to equity hybrids, and then we need to sell solutions. We need not sell products. So that is the shift which we need. It's happening. It's happening. Major towns have seen this shift. in a big way, we have to reach out. So as a manufacturer, as a leader in the mutual fund industry in India, as a State Bank of India's prodigy, we feel that this is our responsibility to come out with the right products and educate the intermediaries, educate the distributor partners. Okay, look, this is a lowering margin era all across the industry, in every industry. You have to do more volumes. We have a beautiful India growth story. We have a beautiful demography in our favor. You please reach out to 5 times more number of people. Do more business, even with the less margins, you will grow.
So, interesting point, Mr. Singh. If we're talking about low margins, I saw that the most recent NFOs, the large number that we saw over the last couple of months, practically half of them are passive in nature. Is that a trend that the industry is likely to see in the foreseeable future as well? More products in the passive space, less new products in the active space gravitationally that keeps moving towards the passive side?
No, I look at it differently. See, on the active side, there are specific categorization has been which has been formulated by SEBI, and you have to have only these products. Whatever products came into the active side earlier, and now all the big players, their bouquet is complete.
Right.
All kind of categories, whatever could be there, are there. So naturally, there's no scope for any more NFOs in that category. Then you can do only thematic.
Right.
But SEBI is very clear now that thematic should not be for the heck of it.
Right.
And rightly so. Okay, I should not be creating a theme just for heck of creating a theme, so that I can come out with NFO with the lower margin, I can pay higher. That may not work. So that's something. And so the passives is the other. So now everybody is trying to complete the bouquet on the passive side. That's why we are seeing more of the passives. Even we, only yesterday we launched 5 passive funds in one go.
Right.
3 on the debt side and 2 on the equity side.
Correct.
But there could be a index fund, there could be a Nifty 50 index fund, which almost everybody has. Now a small cap, mid cap. So now over a period of time, those categories will also be over.
Understood.
Okay. So then you will not see any more NFOs.
Fair enough.
Yeah.
But see, one has to also understand this. I think this conversation, Mr. Singh, has been going on for the last 3 years at least. Where on the large side of the spectrum for equity funds, largely active has not been able to beat the passive side. They've not been able to beat the benchmark, certainly. And so cost-wise also it makes sense to go on the passive side. On the small cap, on the mid cap side, your fund especially has been able to beat the benchmark and peers by a large margin. So there is case for alpha there. Is that really the messaging that people will take going forward?
See, 2 things. First, we firmly believe that at least for next 1 decade, there are enough alpha generating possibilities available in India. The way Indian businesses are growing now, especially post-pandemic, when we are talking about China +1 or India alone in the emerging markets, the ease of doing business by the government, so many good things have happened as far as business is concerned. So it will be always be with a lag when the good performing companies will become part of the Sensex. And on the other side also, there may not be very good companies who still will become part of the Sensex. So it's on the both sides. So there, in the passive side, if the bias of fund manager is not there, the responsibility of fund manager is also not there.
Fair enough.
That's one part. People always say that by going to passives, you will not have any fund manager bias, which is generally seen as a negative thing.
So that is taken. I take that point. But the history or the returns that you've seen over the last, say, 5 years at least, are showing that it's harder to beat the benchmark on the larger side.
It will be harder. It will be harder. But there are capabilities, and I don't agree that most of the there was there was a window of 18 months when only 5-6 stocks were going up and up and up. Okay, so that's why it was seen that you are not outperforming the benchmark. But if you look at the last 18 months, most of the funds have outperformed.
Right.
So when we look at the window, you have to break it, right?
Yes.
This is because of that window of 18 to 24 months, only 5-6 stocks were going. And in mutual fund, you can't have more than 10%
Correct.
in one stock.
Yeah.
So you will never be able to outperform.
So your growth is limited.
Your growth is limited. And second, see, from the investor point of view, this is from the statistical point of view.
Correct.
You are looking at the
Right.
See, as an investor, if I'm an investor, so what I want better than my FD returns,
Yeah.
little more and tax efficient returns.
Right.
Have mutual fund not been able to do that? Then it's a question. Even if I have not beaten the benchmark.
Sir, par ye dil mange more. I guess
that's absolutely right. Yeah. But see, ultimately, among the three stakeholders as far as mutual fund industry is concerned, is mutual fund, the manufacturing, the intermediary, and the investor.
Correct.
Investors' expectations are something different. Am I saying that everybody will put money here?
No.
In passives? No. So then they have to believe, they have to trust somebody, because see, there are some other issues also. Just for example, there is a definite template for any fund manager to follow. That you have to meet the management, you have to look at the business model, you have to look at the growth story, you have to look at the competitive advantage. True. All these things are there. If there is some company, some particular share is going up and up, but corporate governance, there are issues, or we are not having access to the management, or there are some other issues, will fund manager be able to invest in that?
No. The answer is obviously no, because you, as a fund house, you have
rules. As a percentage, if that happens to be in a benchmark, so naturally I will be underperforming, because I don't want to put it in.
There will be vulnerability.
And the reasons for share price going up, many.
Correct. I want to ask about fixed income as well, because this is something I think that is very close to your heart, where perhaps nearing the end of the rate hike cycle, what is your expectation as to where the policy rate will culminate? I think there are a lot of views out there based on the inflation print, of course. But what's your view, and how should an investor position themselves right now to take advantage of that? Do you think it makes sense in a short while to lock in at those higher rates for, say, 4 years, 5 years, if it's available, the product?
No, one thing our fund house view is that we are near peaking, maybe 50, 100 basis point more than this from here, but beyond that we can't afford. So it's definitely makes sense to lock in money at this point. Start locking in money. I will not say lock in money the whole hog, but start putting money at these levels. And our view is definitely in 2 to 3 years time, there will be enough capital gain possibilities there.
Okay.
And in any case, especially these new
for the cycle to turn again.
For the cycle to turn, and then naturally there will be capital gain as per valuation. So, but this target maturity funds is a beautiful innovation. Because earlier, if you have to lock in, you have to put in FMP only.
Correct.
And there was no liquidity. Though theoretically there was that you are listed in the market, but there are no buyers.
Are there enough target maturity funds across? So if I was to say I need to ladder from 5 years all the way up to 12 years, is that now that bouquet is comfortably available? I told you
yesterday when we launched three,
you said,
one is 27, 5 years, one is 7 years, one is 36, that is 14 years.
Right.
You can put anywhere.
Correct.
This is depending upon your courage and your this thing. Because, and second, there's hardly any gap between the corporate bonds and the government security. Very less. And we are putting money in government securities or SDLs.
Right.
No credit risk, no liquidity risk, only the valuation risk for temporary. But if you have enough time to at least wait for 1 to 2 years. 1 to 2 years, I don't think when there are opportunities for capital loss, when your money will remain protected.
Yeah.
And if you want to put money today and want to withdraw after 2 months, there could be that's a negative valuation.
And if you aim, for example, to have a 5-year fund, you hold to maturity, you're going to get your money back.
You're going to get that person. When expense ratios are very low, and the security which is there is very, very good. I think this is the best time.
Then on that front, my question with regard to fixed income is there still merit going in for active, or do you think that target maturity funds passive is the way to play it?
And again, both.
Both.
See, for like the dynamic bond fund,
Hmm.
when the fund manager, because see in the debt market, in the fixed income market, one thing is there, the general views are unanimous.
Hmm.
Unlike the equity market, somebody feels something different. Here everybody feels that now RBI will raise by around 50 basis points.
Hmm.
So 50 could be 40, 50 could be 60, whatever, but could be the case. But definitely there is going to be hike.
Hmm.
Everybody knows, and this is almost pakka. So you can take a call once you feel that yes, you have really peaked up. And the dynamic bond fund, why 14 years? He can take it to 20 years, 30 years also
Correct.
to make the benefit. Okay. So that opportunity you will miss out if you are putting in this target maturity funds.
Fair enough.
Whether you, and there the equal chance of again what is so called the fund manager bias. The call of fund manager can go wrong as well.
Yeah.
So that's
My last question, and I want you to perhaps give me a projection, because this is something that I want to. Where do you see your business going? Is that going to be your strategy, going to Bharat over the next, say, decade or so? And what is the kind of penetration in your book that you will see that will come purely from Bharat?
Bharat, of course, is not my choice. Bharat is my responsibility.
Sure.
With my name, if I don't serve the Bharat, I don't deserve to have SBI's name. That's very clear. So we'll be very clear on that. But at the same time, we'll go to every kind of see this thing, because we after becoming the largest fund, becoming largest meaningfully. So whatever is happening, which is on the non-banking side of the business, on the financial side, we should be there.
Okay.
And we should have a meaningful leading position.
But is there a target that you have that you will say that, see, already you have a significant portion of a SIP book that's coming in from smaller towns and cities?
My only thing will be in 10 years, if you're talking about a decade, SBI Mutual Fund should be the global fund house from India.
Okay.
It's not catering only to Indians, not catering only to Bharat, but catering to everyone across the globe who wants to be in India, or for the Indians who want to be outside India.
Okay.
Both exports and imports. That is the vision. We should be covering everybody, but at the same time, the tagline will remain, the wealth creator for every Indian. That's the tagline.
Fantastic. On that note, thank you so much, Mr. TV Singh.
Thank you
for
very much.
taking the time.
Thank you. Thank you. It's a pleasure talking to you.